But a lot of people, they have complete faith in the paper market, or they don't think about it too often. And now we're getting the mainstreaming of this when Elon talks about it, and it's invariably when it's a pain point. And of course, he says it's bad because he sees it from his perspective, which is an input cost that's too expensive. What he didn't say was the central banking cartel of proliferators that have created excess debt, excess spending, have been debasing your fiat currency, and now we have a groundswell loss of confidence in the fiat and debt system, and as a result of the central... So you're referring to silver's run or gold's specifically? Because they've both been magnificent. Silver, yeah. So silver's doing everything we believe it should be doing, and doing so very getting more volatile, it has to be said. And I think some of that has got to do with the fact that we've had a little bit of light trading markets in the lead up to Christmas, post-Christmas, and the lead up now of New Year. So we're recording this on the 31st of December. Happy New Year to everybody by the time they watch this. And my overall take is that we're getting a little spike in volatility. I do want to highlight that silver margins for speculation have jumped twice. It may be worth, I can talk through this. I don't suppose I have to screen share for that, but we're on the 5,000 ounce contracts, the COMEX 5,000 ounce contracts. You are at 20K. They then upped it to 25, and they've now upped the 25 to 32.5. So that's a case of two back-to-back increases that have essentially taken you from 20,000 to 32,500 in total. That additional 12,500 is about 62.5% that you've had in quite short succession in two separate moves. So that will have caused a bit of chop. I would argue there's a couple of interesting things going on, and it becomes a question of which is the real market. And my opinion is that the Shanghai is now the real market for silver. It may be worth sharing the differences. There is a premium between the COMEX and the Western world's pricing, all aspects of Western world pricing versus Shanghai. And I would say also that an immense amount of delivery seems to be taking place. That's the other thing that's happened that's driven this, in that there is real... So here's the difference, in a sense, between gold's performance and silver's performance for me. Gold is the banner for the debasement of debt and fiat. And you've got out of that a catch-up year of 70% because we've been debasing slowly for a lengthy period, and we've actually had gold and silver suppression where it wasn't allowed to catch up. It should have been linear. Every year you lose, you were experiencing 3-5% inflation. You should have had a 5% move in gold and silver. But for decades, it hasn't been like that. So here's the great gift that you're getting. You're getting catch-up moves for suppression error. The difference between gold and silver in terms of their performances is that in the silver markets, it was the ultimate suppression tool, and you had above ground availability that has now largely been far more depleted, and you have real deficits of supply that have existed for multi-years. So in the silver part of the gold market, not only are you getting the inflation debasement trade elements that has driven gold, so you start with the 70% gold has, you've also had, as a loss of trust in the Western system, you've had people saying it now matters more to physically hold and control the actual metal. So they have been increased delivery, mark for delivery component in the futures market has actually seen a massive run in you don't own it unless you hold it physically. So we've had lots of images on X of even just retail Chinese people with the very popular 16 kilogram slabs, which are 500 ounce bars. The largest standard is 1,000 ounce bar. I think I stand corrected that when they say 5,000 ounce, I think it's 5 of the 1,000 ounces is the contract. but I might be incorrect. Someone will correct me below. I'll have to double check that. But anyway, you're having a two-tier pricing system as well. So the West currently represents, in essence, a discount window for the East. And if you want to follow what direction COMEX Silver or your broker in who you're trading with in the silver markets in the Western realm, what's likely to be happening, whether you're going to be going up or down, it's almost more beneficial to be watching the Shanghai price, because you get the Asian session and you see what happens there. And the Western market is now following the Eastern market, because the delivery market, the most aggressive delivery market, is now in the East. And that's the difference. That's the premium on top of gold. So silver starts with the 70% monetary metal debasement gains that gold has had as almost a natural, that's what they're all getting as monetary metals. And then on top of that, it's getting the actual shortage, the run on the physical shortage. Gold, less of a shortage aspect, because a lot of bullion stored. Central banks hold a lot of it. They can lease it out, lend it, do whatever. But in terms of consumption, silver has consumption. So I think that's the difference between the two, which is the main driver behind your question. How long does silver outperform gold? I also dropped other things in there, like watch the Shanghai price, but I'll hand back to you on that.
One clear catalyst behind recent turbulence has been a sharp increase in futures margin requirements. In a short span, silver margins rose dramatically, effectively raising the cost of speculation by over 60%. Historically, such moves are designed to cool overheated markets, especially during periods of thin liquidity. While officially framed as risk management, these actions often dampen retail participation and slow momentum. The result is short-term price choppiness. Yet margin hikes do not change fundamentals. They may suppress price temporarily, but they also reveal concern. When leverage must be restrained so aggressively, it suggests the underlying market is far from stable.
I think any place that is doing actual delivery on the highest level, as always with technical analysis, they'll always say volume is an endorsement. It's like a number of voters for a certain price. If you have a very thinly traded item, I could list a family held company where me and my family members hold 95% of the equity, and we have an IPO with a very minor amount, and we let the market push it around. And at any point, we can whale in and buy up our own remaining 5%, or we can dump it. That changes the entire market cap valuation, including for the 95%. So we'll always say to you, volume, true volume is an endorsement for the price. Thin volume is not necessarily as strong an endorsement on the price. So in the case of silver, I'll say where the bulk of the delivery is taking place. That said, it would not be accurate to just say that COMEX and LBM are just paper markets, because what's actually happening is delivery is being called for there too. But you do still have this premium. It's worth possibly showing that. So this is the Chinese contract adjusted from Chinese yuan to dollars and adjusted to ounces from kilograms. That AG, this formula you see up here. So I'm talking up top here. AG1 with the interrogation mark is the front end contract on the futures market. That is the USD to the Chinese yuan adjustment, because obviously in Shanghai it's in yuan. And so there's a currency rate in that. And then that 32.150747 is me being a little bit OCD to the umpteenth degree on the conversion of kilograms to ounces. So metric system to the accepted. So this brings this chart over here to being the leading chart, I think, for silver prices. I'm on the 1 hour mainly because I'm just trying to show you the events of recent, because many people that are regular watchers and viewers, they know already that you and this channel have been suggesting everybody should be bullish, the silver market, and they're all wondering what do we make maybe of the recent events with the price. The one on the left here is your US stroke Western world pricing. Let's go with a different color, and it's just your standard silver market. And you can see technically you kind of this dipped a tiny bit lower. Let's just see. We had a dip down over here. You can see they're trading at different prices, first of all, and there's a premium in the east. So you've got a roughly around 76 at the moment in Shanghai on the formulaic adjustment. Now, I'd imagine markets being relatively efficient, that $4.30 is probably what you would lose if you took delivery in the West at one of the standard areas and shipped in volume. You'd probably have a very marginal profit or a marginal loss. The markets are kind of quite efficient like that. So the West still gets to trade cheaper for now because there's a frictional cost to have it made available, Western delivered silver, made available to, say that East, someone in China. So they'll keep buying locally where it's just a case of you get it delivered at 76, because to buy at 71, 78, as we are here, by the time you've done everything else, you'd need to have a large amount of scale, and you'd probably barely be worth it, and a lot of extra hassle. So that's the premium difference for arbitraging the different markets. These are frictional. But what you'll notice is that if I just tidy up, we traded lower over here, and we took out that low on the Chinese market. But by the time the Western market opened and it was trading down, the Chinese market started to trade back up towards that. So we got a floor in a little bit earlier, and we've been maintaining that premium. Also bearing in mind they have different trading hours. So sometimes one is not available, and then the other one drifts on its own.
A defining development is the growing divergence between Western silver prices and those in Asia. Increasingly, the Shanghai market appears to be setting the tone, trading at a persistent premium to COMEX. This gap reflects where real demand resides, where metal is actually being delivered and consumed. In contrast to paper-heavy Western markets, the East emphasizes physical settlement. Asian trading sessions now often lead price direction, with Western markets reacting afterward. When price discovery shifts toward the regions demanding delivery, it challenges long-held assumptions about which exchanges truly represent reality. Volume and delivery, not contracts, are becoming the ultimate validators of price.
But I'd start to suggest that this formula might be closer to your true market, and then you have to have a feel for the percentage differential. If we were to take it at current values, you're around 76 and 71.72. So if you make it it looks like about 6%. If it was 10%, it would be about $7 on 71. That would take you to 78. So I think you're around 6 or 7%. That's sort of not quite worth it, arbitrage, frictional cost. But at some point, in truth, these should be very similar. But the difference is the rush in demand for delivery and the real surge, as the workshop of the world, is out east, China, and also, it must be said, Korea. You think of Samsung TVs, devices, etc., that have even gone direct to mines and apparently made investments and secured supply direct to source. That's silver that won't even make it into the exchanges because it will be provided direct to manufacture. That's going to have a knock-on effect on supply as well. So that's the two stories. If I'm just sharing the chart, I'll also, while we've just got the share screen up, just show you that margin changes, which I think would have just reduced some of the retail further. We had current initial margin at 25. That's on the COMEX 5,000 silver futures contract. Current maintenance, and then the new initial maintenance is now 32.5. And it wasn't that long ago, it was barely a week, that you were moving from 20 to 25. So you've effectively, in quite short duration. This is at their discretion, and of course they'll want to tame the market. Many people see them as co-conspirators with the banking cartel in terms of the suppression of silver markets. So they don't want any speculators getting hot and rich on a bank that's heftily short. There's been quite a few rumors that there were banks unable to deliver. A bank, many banks, one bank, who knows, or maybe just a rumor that doesn't have any validation behind it. So they took some of the sting out on the thin markets with these margin, but nothing on the big big picture in terms of what we expect. We expect a 90.5 run as a interim target. We expect 333 as a full target, but not the final high. And we expect 4-digit silver in a dollar debasement, a chronic era, where the gold-silver ratio will be heading towards single digits between each other. So in terms of everything we've spoken of before, Jesse, no changes there.
Gold and silver share a common foundation: protection against currency debasement. Gold's rise reflects decades of monetary inflation finally being priced in. Silver, however, carries an added burden. It is both a monetary metal and an industrial necessity. Unlike gold, much of silver is consumed and not recycled. Above-ground inventories have been steadily depleted, creating persistent supply deficits. This means silver benefits not only from the loss of trust in fiat systems, but also from real-world scarcity. Gold protects wealth. Silver is being used up. That distinction is critical in understanding why silver's upside pressure may ultimately be greater.
It's a very good point you make. I mean, I've retweeted about the China export thing, but there's a qualification in that I didn't put in the tweet myself, and that is there's 44 companies already licensed to allow export of silver who are recognized merchants for some or other commercial reason that can export regardless. What is probable, though, is China has reduced the possibility that random people can show up and start sending metals over the board. And they said there's only 44 companies that can export. We want them registered. We want to know who they are. And at any given moment, they could say nothing for this week or nothing for next week for whatever reason. And those people who would want to retain their license would absolutely comply, or they'd find themselves shut down. So it's more about grabbing the reins and the ropes, and what's in our country is staying in our country. What really needs to go out for a valid reason can go out, but we get to know every single ounce and who's doing it, and they have to report to us the amounts, and we'll be controlling that. So it's more a step in that direction than complete export ban in the absolute sense. So it's good that you make that qualification, and I just put an extra tap of the hammer on top of that nail so that everybody's clear. But there's no doubting about the trajectory. Governments want the information, the data, and the control over how precious metals, critical minerals, and metals are moving in terms of in and out of their land, and they're not going to have themselves depleted of key strategic resources by rogue commercial elements or even retail that are trying to arbitrage a market for personal gain or do anything else. So the reins are certainly taken up and the control is brought. So that's point number one. You also mentioned our friend Elon Musk, who's actually a big silver consumer, reflecting his concern. And that kind of went with the rampant climb in the margins. So we could see that suddenly we were going mainstream. By the time Elon's tweeting about it, a lot of normies that just follow Elon because he's always put in front of you on the algo that aren't involved in precious metal sound money discussions particularly, suddenly there's something going on here. So we've had our first little flurry of mainstreaming of this trend that since my YouTube channel, by the way, at 2009, I started it. And I started speaking directly and immediately about sound money and precious metals. And it was something I was watching for 2-3 decades before that. Literally from when I was at late teens through 20. Sound money was of precedence because of great leaders I had around me, watching speakers like Ron Paul and people before him that all deserve credit. So sound money always was central to what I did.
Physical delivery has become the defining theme of today's silver market. From institutional buyers to everyday savers in Asia, demand is increasingly focused on metal in hand, not promises on paper. Governments are responding as well. Export controls, licensing requirements, and tighter reporting are not bans, but they are reins. Nations want visibility and authority over strategic resources. At the same time, major manufacturers, particularly in technology and electronics, are securing supply directly from mines, bypassing exchanges entirely. Every ounce locked into long-term industrial contracts is an ounce removed from tradable supply, quietly tightening the market further.
But a lot of people, they have complete faith in the paper market, or they don't think about it too often. And now we're getting the mainstreaming of this when Elon talks about it, and it's invariably when it's a pain point. And of course, he says it's bad because he sees it from his perspective, which is an input cost that's too expensive. What he didn't say was the central banking cartel of proliferators that have created excess debt, excess spending, have been debasing your fiat currency, and now we have a groundswell loss of confidence in the fiat and debt system. And as a result of the central banking cartel, people are moving into physically held that actually gives them sovereignty in their own personal place. And by the way, my shoulder pressing number in dollar terms keeps going up. So I'm convinced I'm getting financially stronger, if not physically stronger, are running into the precious metals as sound money. And he's, of course, there from an industrial perspective, but I wouldn't surprise me if he's personally stacking and is very familiar with those things I just mentioned. It's just not the kind of thing he talks, because it'll get all the wrong people on his back, including Donald Trump, which he seems to have patched up his relationship with and all of that, and the Federal Reserve. So you don't get away as a billionaire with criticizing these people when you have far reach. You have to be far more politically astute than me. I go out throwing stones at everybody because nobody cares. We're a YouTube channel that just crossed 100K. Thank you for all your followers, by the way, that have come across and supported us in crossing that key landmark. So what happened is you had a little explosion of awareness into the more normie world, and you've seen responses that have gone hand in hand with that, so that as soon as normie world discovers it, straight away you get the right price action, comes back down. You see normies, if you chased in, you got slammed, it's been handled. That'll mean it'll go back to sleep and people will forget about silver for a while. And for me, that's exactly what I want, because we'll base, we'll rebuild, and we'll push on to new highs in due course. So that's my take on the little explosion of awareness to non-sound money world.
Moments of mainstream attention often bring short-term chaos. When silver briefly enters popular discourse, amplified by high-profile voices, prices spike, late entrants rush in, and volatility surges. Then, just as quickly, attention fades and prices cool. This cycle is not failure, it is digestion. Markets reset, build new bases, and prepare for the next advance. Long-term trends are shaped not by viral moments, but by structural forces: supply deficits, monetary erosion, and physical demand. Silver's story is not finished. It is unfolding slowly, deliberately, and largely outside the spotlight. That is often how the biggest moves begin.